Guys, one of the most frequent questions I get asked is, can you explain the all-in-one loan quickly in like less than 10 minutes? Well, I love the 30-minute videos and all of that, but I'd like a quick version of it. This video is exactly for you if that's what you're looking for here. But pay attention, because at the end of the video, there's going to be a test. I'm not kidding, and we're going to see how much you learned as you listen to the all-in-one loan in less than 10 minutes. Okay, guys, let's explain the all-in-one loan here in less than 10 minutes to you. First, to understand, the all-in-one loan is a first position home equity line of credit, HELOC. Just like his second position HELOC, only this loan has to be in first position, one of the fundamental differences. Another difference is it's linked directly to a bank account. So when you make deposits or withdrawals out of that bank account, it has an impact immediately that day on the balance of the line of credit and on the interest rate calculation. It is the only loan I know that will allow you to make a deposit, drop the balance of the line of credit by the amount of the deposit, calculate interest after that. In other words, it pays principal first and then calculates interest second. So those deposits and withdrawals have a daily impact on the balance of the line of credit and hence on the interest rate calculation with the line of credit, and it reacts to positive cash flow in a very positive manner, which I'm going to explain in the next session here for you. All right, guys, let's do an example of an all-in-one loan on a 30-day month here and see how this thing works, okay? So this axis right here represents the days of the month as we go throughout the month. This axis here represents the amount that's available on the all-in-one loan. So let's assume that you set up the all-in-one loan with a balance available of $300,000. So you could potentially draw up to $300,000 on this line of credit. But instead, you decided to draw $150,000 because that's what you needed. So understand, on the first day of the month, no activity on the line of credit or on the bank account that it's linked to, your interest expense is going to be on the $150,000 that you owe. What the all-in-one loan does is it takes a daily interest calculation for each day for the interest expense for the balance that's on the line of credit that day. It tabulates that up. It keeps track of that throughout the month. At the portion, and sometime during the next month, it's going to charge the interest expense back to the all-in-one loan, and that's how it pays itself. It's automatic. You do not need to do anything yourself with the all-in-one loan to make these payments. So let's assume that you go all the way through the first 5 days of the month without making any deposits or any withdrawals. So for the first 5 days of this month here, the interest expense that's calculated is on the $150,000. But on day 5, you do a $10,000 deposit into your bank account, lowering the balance to $140,000. Now, I get that's not to scale. This is for illustrative purposes only here. So then on day 5, because of that deposit, the amount of the interest expense is now on the $140,000 balance. It first of all applies the balance to the all-in-one loan. Then it calculates interest after the balance, which was lowered in this particular case by the amount of the deposit. But you have to pay things out of the bank account. You have to pay bills, maybe the mortgage, things like that. Payments come out. So throughout the next few days, things come out of the bank account. These are checks, debit expenses, whatever, auto expenses, whatever you might have on the line of credit go out. And each day that happens, the amount goes out of the bank account. It increases the balance of the line of credit. The interest expense is on that day's balance, so the interest calculation is going to be a little greater for that day. But then on the 10th of the month, you make another deposit. And then you have to make some more payments. And on the 15th of the month, you make another deposit. This loan works extremely well for people that have positive cash flow through the bank account. So they don't live paycheck to paycheck. They typically have something left over at the end of every month, maybe 10% or 15% of the deposit activity or anything greater than that. And so over a period of time, you're going to see that the balance of the line of credit is going down. Now that's pretty steep and for illustrative purposes again only, but understand as the balance of the line of credit goes down, so does the interest expense on a daily basis. That's what makes this work so well. Okay, one of the differences of the all-in-one loan is that's a first position line of credit, as we have explained. Another fundamental difference here is that it's also a 30-year line of credit. So what I mean by that is this. Most lines of credit you can draw upon for up to 10 years. So this axis here, it represents years. In this case, it's 10-year mark right there and 30-year. This represents the available balance which you can draw upon on the all-in-one loan. So most lines of credit are similar to this. You can draw up to 10 years, and at the 10-year mark, typically what happens is the draw availability is now gone. You can no longer draw upon it, and whatever balance is left amortizes out with whatever interest rate you're using for the line of credit over the remaining 20 years. So your payment goes up by a lot, and you can no longer draw upon the line of credit. All-in-one loan is different. at the end of 10 years, what happens with the all-in-one loan is the available balance to draw upon decreases over the next 20 years by 1/240th each month, because there are 240 months left in 20 years. So there's a straight line available balance that's decreasing over that 20-year period. As long as you stay below this black line, you can draw on it. So typically what happens, let's use our example before. Let's say someone took out $150,000 on their all-in-one loan, and they did their positive cash flow every month. Typically, what typically happens is the all-in-one loan gets paid off much more rapidly than a typical loan because of that positive cash flow. It reacts very favorably to that. So if that was the case, you might be able to pay off the all-in-one loan in something less than 10 years. You still have all of this available to draw upon should you want to do so. And what happens oftentimes, the all-in-one loan is great for two things. One is possibilities, opportunities, and the second is emergencies. So let's say an opportunity comes along sometime around here, and instead of continuing to pay down the line of credit with the positive cash flow, person decided to pull some funds out for an investment opportunity. Maybe they're buying another property, they needed a down payment. So the available balance goes up, the amount that's owed goes up on the line of credit to whatever that amount is there. But they get that positive cash flow coming in from the property, and they put that right back into the same bank account, and they just start accelerating that process of paying it down even quicker. So what happens is it starts paying it down again, much more quickly kind of thing. That could happen throughout all this time for the 30 years. As long as you stay below this black line, you have an available balance available on the all-in-one loan to draw upon. You can't go over that. So you can see that the amount available to you starts decreasing, and after 15 or 20 years, it's a lot less than it was when it originally started. All right, guys, let's wrap this up by going over some of the features of the all-in-one loan, so we'll make sure we cover everything for you. You understand now that this is a 30-year home equity line of credit. You can draw up to 30 years on this line of credit. Remember, as long as you stay below that black line that we showed you there, it's available to you. It's tied directly to a bank account, and so with positive cash flow going through that bank account, more deposits typically than expenses coming out, you have a very good impact to the line of credit, and it pays it off very quickly over time. There is an annual fee that I want to mention to you. It's $60 or $65. It's not great, but it is there, so you want to be aware of that. Types of properties that you can put the all-in-one loan are your residence, your owner-occupied home, your second home, or your investment properties. However, there is a limit to the number of all-in-one loans that you can have, and I believe right now it's 3. Now, these things can change over time, so certainly give a call if you have any questions on any of these features, and we could talk about them and look at your specific situation. The all-in-one loan is a great tool. It's a great tool for building wealth, especially for people who understand that. And so we're going to strategize how it can be best used for your situation to help build wealth for you. But it begins by wondering or explaining, seeing if it's really a good loan for you. And you can determine that by going to AIOLoan.net and logging on to what's called the simulator there, where you'll be able to put in your own specific information, your deposit activity that you typically run through a bank account, and the expenses that come out of that bank account. Once again, if you have greater than 10 or 15% of deposits typically left over at the end of the month, it can be very good. And the simulator will show you just how good. It'll anticipate and show you what it thinks you'll pay off your loan and how quickly that'll happen. It'll give you an effective interest rate, and it'll compare it with the 30-year fixed rate that you can put in there, so you can see which one might make most sense for you. I do want to mention one other thing here. The all-in-one loan is great for people that have variable income as well. So if you're an entrepreneur, or perhaps you're someone with commission income, and you typically have really good income relative to the expenses, but sometimes your income's low, business is slow or whatever, and the expenses are actually greater, the all-in-one loan is a great loan to help you get through that. Because remember, if you stay below that black line and you have available equity on your line of credit available to you, and you have a bad month with income, all that happens is the balance on the line of all-in-one loan is going to increase. The payment happens automatically. You don't have to do anything at all. The interest is assessed at the end, or not the end, during the next month for the previous month, and it's an interest-only payment. So it'll go up by the amount of the interest, and you can get through 1, 2, 3, or even more bad months until the cash flow resumes and you're able to start paying it down again. If you have any questions on the all-in-one loan, guys, or any other loans, we do all kinds of loans here. Don't hesitate to give me a call. My information will be on the screen. Okay, I hope that helped you out. All right, here's the test that I promised you. First of all, how long can you draw upon the all-in-one loan? You're correct. 30 years. That's one of the special features about it. Yes, and one of my other questions we typically get is, how much does the all-in-one loan cost? Well, that's kind of tricky, isn't it? Because I didn't tell you. But the all-in-one loan basically has the same set of fees as a regular first mortgage, not a second position line of credit. You want to know that going in. But it's certainly worth it when it saves you potentially tens of thousands of hundreds of thousands of dollars over the time of the loan kind of thing. Last question. Who is the all-in-one loan made for? Well, you should probably know that one. People with a positive cash flow, this loan is ideal for. If you want flexibility for, again, opportunities or emergencies, all-in-one loan could be for you. If you have any questions at all, don't hesitate to give me a call, send an email. My contact information is on the screen. Happy to answer any questions for you. Thanks much. Bye-bye.